investors are looking to pick up the pieces after President Donald Trump announced a 90-day pause to the sweeping reciprocal tariffs. That sent stocks plunging, but many on Wall Street suspect chaos in the bond market truly forced the administration's hand. A confounding spike in yields sparked fears of a liquidity crisis, and the collapse of the so-called basis trade may have been one of the main culprits. In normal times, hedge funds borrow heavily to take advantage of tiny price discrepancies between treasuries and futures linked to those bonds. They profit handsomely and in turn help keep money markets humming. The COVID-19 pandemic and recent trade policy upheaval have shown what can when happen the $800 billion trade unwinds. However, and some experts think the Federal Reserve needs to be better equipped to handle the next potential crisis in, say, 3 months or so. After all, fixed income markets can be fickle. Investors initially piled into treasuries last week as stocks plunged, but the tide soon shifted, even as the carnage in equity markets continued. Yields, which represent an investor's annual return, rise as bond prices fall, and they spiked early this week as a sell-off in U.S. debt raised questions about its typical safe haven status. Treasury Secretary Scott Bessent has said the Trump administration wants to see a lower 10-year Treasury yield, the benchmark for mortgage rates, car loans, and other types of borrowing costs. Throughout the economy, it spiked above 4.5% on Wednesday morning. And while the stock market soared after Trump's pause, the reaction in bonds was more muted. As of Thursday afternoon, the 10-year yield had again surged past the 4.4% mark, even though stocks shed part of their gains from Wednesday's historic rebound. Shortly after, Trump announced import taxes on goods from most countries, excluding China, would be reduced to a baseline 10% charge. Bessent denied bond market volatility was behind the president's flip-flop. But Kevin Huss, Trump's head of the U.S. National Economic Council, told CNBC Thursday movements in the Treasury market had added, perhaps, a little more urgency to the decision to temporarily scrap the reciprocal tariffs. The White House did not respond to Fortune's request for comment. Whatever the case, the unusual increase in long-term interest rates amid an equity sell-off has been akin to a murder mystery, said Torsten Slok, chief economist at private equity giant Apollo. That's telling me that there are some distress for sellers out there, he told Fortune. Someone who's selling not because they think the economy is good or bad, or inflation is good or bad, or that the Fed is going to hike, or not hike interest rates. To be sure, many commentators have also cited foreign selling as a possible cause. Trump has announced a 145% tariff on goods from China, the second largest foreign holder of treasuries, leading to questions about whether Beijing might retaliate by dumping some of its roughly $770 billion of U.S. debt, or simply have less reason to buy American assets as bilateral trade decreases. However, if that had been a major factor this week, Slog said he would have expected to see a more significant weakening in the U.S. dollar, which did fall more noticeably on Thursday. Goldman Sachs, Reese, William Marshall, and Bill Zhu agreed. We would not rule out a diversification away from dollar assets over time, they wrote in a note Wednesday. But the near-term behavior appears more consistent, with some anticipatory concern about that possibility, in conjunction with unwinds of levered longs. In other words, this is what can happen when hedge funds are forced to dump treasuries. En masse in extreme cases, liquidity can dry up, posing a threat to the broader economy if the Fed doesn't step in. How the basis trade works. Hedge funds are presented with an arbitrage opportunity. In the first place, experts say, because of a fundamental imbalance in credit markets. Many asset managers of mutual funds Pension funds and insurance companies have long-term liabilities, like payouts to retirees decades down the road, and want to buy assets with similar exposure to interest rates or duration over that SPA. The classic way of doing often involves buying large amounts of Treasury futures contracts. But someone needs